Morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shrum, Senior Market Specialist at FXCM, and today is Friday, it's the 3rd of June 2022. It's non-farm payroll day, so I'm just going to put the link for our live trade. It will be a live trade on a live account, so we won't trade a demo, we'll trade it live. So just want to put that out there. That link is in the chat. If you need to contact me, just want to encourage you to send your emails to rshall@fxcm.com. I'll bring up our high risk investment warning. Good morning, Rob. Hope that your fossil hunting was successful, and very nice to have you on the webinar as always. Thank you, everyone, for joining. I appreciate it. I am aware it's a long weekend in the UK, and of course, I hope everyone is enjoying and celebrating. I'm going to bring up the market commentaries disclaimer. I'll keep this on screen for a few moments. Hey, Anna, Raj, nice to have you guys on the webinar. Thank you, everyone, for joining. And just lastly, references, Market Scope 2.0. Again, we're just going to reference Bloomberg. So the European article, I couldn't find it on CNBC, and I think it's linked to the long weekend. So I think from Monday we'll be able to go back to the CNBC. But in the meantime, we'll just use the email that I received from Bloomberg. I do prefer the CNBC for the morning review, but the Bloomberg will be fine for our purposes. And here is also tradingview.com. We'll possibly be using that as well. And I think just to get started, let's go through the Bloomberg email. It's 5 things to start your day. It reads as follows. So this is the first thing they talk about is oil. Opening the tap. OPEC Plus has agreed to open its oil taps faster in the summer months, a gesture of reconciliation to the US that nevertheless keeps Russia at the heart of the cartel. So OPEC's actually kind of playing an interesting political sort of game there. They've got to appease the US, but they've got to also appease Russia, and they're kind of caught in the middle. So it's just an interesting story that's developing. The modest supply boost amounting to just 0.4% of global demand over July and August may ease tight markets, but it leaves unanswered the question of whether the US can turn Saudi Arabia into an ally in its campaign to economically isolate Russia. Only Saudi Arabia and the United Arab Emirates have enough spare capacity to offset a significant portion of the supply gap created by sanctions on Russia following its invasion of Ukraine. And I think we've mentioned that before. The only OPEC countries that can really boost supply, Saudis and the UAE. All the others have an aging infrastructure there. Okay, much of that will remain untapped even after the July and August production increases. This brings, of course, something that Anna wrote yesterday. Well, what about the refineries? Okay, so we kind of get the Saudis and the UAE filling the gap, but can it be refined? And that's the big question mark, isn't it? So it's, as far as I know, and subject to correction again, the big refineries are in the US and Russia. So now Russia's out of the equation. Okay, so I'm not certain how this plays out. Let's see. Obviously, it's a story that is developing. Let's keep on top of it. All right, let me see the next. All right. Well, so the next one's a very interesting, article. Its headline reads, "Fat Finger. Citigroup may record losses of at least 50 million following a fat finger trade that caused a flash crash in Europe stocks last month, according to people familiar with the matter." The bank is still telling losses from the mistaken trade, and the final figure could balloon higher. A trader in the firm's Delta One trading unit in London was working from home during a banking holiday on May 2nd when the person incorrectly added an extra zero to a trade. This, I don't know how that happens. So there's meant to be risk protocols, but nevertheless, this is the story. The mistake is a blow for Chief Executive Officer Jane Fraser, as well as the firm's equities chief. I'm going to try and pronounce the name. Feta Belbisher, who has been seeking to increase Citigroup's revenue from stock trading. Okay, so lesson there for us, I guess, is just double check everything before we click that buy or sell, right? Next, hey Howard, morning. Anna's writing, Patrick Boyle has a video on the fat fingers trades. All right. So I don't have the link. If you can share that, and otherwise, I'm thinking just go to YouTube, type in fat fingers trades. All right. Next headlines here, staying the course. Federal Reserve Vice Chair Lael Brainard said expectations for 0.5 percentage point increases in US interest rates this month and next were reasonable, and saw no case for pausing the central bank's tightening campaign afterward. Right now, it's very hard to see the case for a pause. We've still got a lot of work to get inflation down to a 2% target, Brainard said. Her voice now adding to the hawks that we've heard this week, right? Her remarks were the latest from officials to reinforce the message that they're staying the course on hiking rates. Financial markets have swung sharply as investors fret the Fed's efforts to curb inflation could trigger a recession. Just looking at it right here, Patrick Boyle on finance, serious, but it's also amusing. Okay. All right, just the last headline, and then we'll just go into sort of the conclusion. Bleak Outlook. BlackRock CEO Larry Fink said he expects inflation to remain elevated for several years, primarily because of snarled global supply chains. That's important here. Supply. So Larry Fink, he's seeing the inflation from supply side. What's the takeaway there? Well, not much central banks can do. They operate on the demand side. Okay, the world's largest asset manager is navigating a world beset by surging inflation, rising interest rates, and geopolitical upheaval. Fink had previously said the war in Ukraine created profound changes to the global economy, forcing companies and governments to reconsider their reliance on foreign markets. His remarks came a day after JP Morgan CEO Jamie Dimon warned investors to prepare for an economic hurricane. Just something I did read on CNBC yesterday. I can't remember the Bank of America's CEO. It escapes me. He also came out. His comments were opposite to Jamie Dimon's. So Bank of America seems to be bullish. Jamie Dimon bearish. Again, let's see how this plays out, right? Okay, here's the conclusion. European shares are on course to follow Asian stocks higher ahead of a key US jobs report. Okay, non-farm payroll Friday today. Link for that live trade, just if anybody needs it, that's in the chat. Investors will be eyeing the data for clues on the pace of policy tightening. The UN's Food and Agriculture Organization releases its monthly food price index amid growing concerns over global supply. So I think that's going to be an interesting series. It's not one that I normally follow, but I'd like to see how it's going. Sweden, Spain, Italy, France, and Germany all report services PMIs. With all that data to sit through, thankfully, it's a light day for earnings, and that brings us to the end of the article. Okay, so Anna's saying something important, not in this article. Russia has cut gas off to 3 more countries in Europe. Okay, so we'll take a look at these charts and let's see how they're reacting. So let's open up. Let's go to trading view here. Let's take a look at. Okay, so they've cut gas off to Netherlands, Denmark, and German companies. All right, thank you very much. All right, well, let's take a look at so let's start off with natural gas, then we'll go to energy. So let's see what's happening here. All right, so we're looking at a weekly. I just want to make sure it's logarithmic. Okay, if we don't have, you've got to have it on logarithmic for longer term analysis. You guys just need to take my word on that. You can't have arithmetic for longer term. It's going to give you very steep. It's going to give you very steep trends because of the mathematics. So you want to go logarithmic, which is effectively percentage scale. Gives a little bit of a it's a more gentle slope and a more realistic momentum measurement. Okay, it doesn't really matter for short-term charts, but for long-term charts, it makes a world of difference. The reason it doesn't matter for short-term charts is because the mathematics aren't severe. The mathematics not severe. So on short terms, pennies, it's not going to make a difference. Long term, we look at dollar amounts. You know, it's starting to hurt the actual what's the right word? Truthfulness, integrity of the chart. Right. So looking at natural gas, this is weekly. What we're looking at here is trend following indicators. I don't even think we need the trend following indicators. We can see the peaks and troughs here. Higher troughs followed by higher peaks. Take a look at the stochastic. Stochastic is very high, and that's dangerous in terms of pushing gas up. So we'll have to see if this is going to be affected by what Anna's just told us here. Let's just go down to the daily, see what's happening here. All right, so perhaps a little bit of a rollover here, but again, you know, because the primary trend is up, you want to always be cautious for dips in the uptrend. Let's go through to oil, see what's happening on that side as well. Okay, so we'll just we'll use the Brent. We'll use Brent as the interest instrument we're going to look at. All right, let's go to the weekly. Okay, this is to me it's an uncomfortable chart because of the ramifications of it. You know, the analysts that are listened to, some would say stagflation is sort of just a buzzword. We're not really in that type of an environment. Some say no, it's a real threat. My opinion is I think it's a threat. As long as oil and natural gas are pushing up, it has to be economics 101. It must be a threat because the supply curves are shifting down. They must be shifting down. I'll explain that in a moment. But so now you can see UK oil. Okay, if it hits this 80, then I reckon 150 is sort of kind of maybe a target. I'm not saying that because of any sort of mathematical forecast. It's a thumbs up, but I mean 150 is gonna hurt unless we can get this thing to turn around, right? And well, we've heard that OPEC's pushing up supply. Is that really going to do anything? Is it really going to do anything? If there's no ways to refine that, is it really going to do anything? I don't know. It almost seems like a gesture, but it's hollow. You know, I think we're in a conundrum without the oil flow of energy, but that flow of from the Russian flow of energy, but that Russian flow of energy you have to sanction because they've aggressively has started a complete nonsensical, incredibly damaging, devastating on all sort of human welfare measurements. So you have to punish them, you have to sanction the oil. But without it, I don't think that this is going to be solved by the increase in Saudi or UAE oil. Who's going to refine it, right? Again, Anna comes up with a very good point. Well, what about the Chinese now, right? Which we've mentioned before. The Chinese were in Shanghai and Beijing in particular were in a very strict lockdown. Okay, that's been relaxed. That's been relaxed. Okay. So does that mean the increase in demand is now going to pull the price up specifically because of the supply issues? The supply issues haven't been solved, and now we've got a significant demand increase again. So this is something we have to keep on top of. Does it hit this 80? And fundamentally, it seems that there's a real risk of that. I think there's a real risk of that, right? Let's go through to wheat, just as the next supply chart. Let's go through to wheat. We'll just put in wheat futures here, FXCM. Yeah, it's been there run up. All right, so this is actually this is a better looking chart. It's a better looking chart. Why is it a better looking chart? Because it does seem as if this resistance is getting a price reaction. Okay, so this is in terms of stagflationary pressures. This has to come down, but again, it's going to have to be monitored. The stochastics not as dangerous. Dangerous is obviously, I'm not sure it's a correct adjective. I mean, the idea here is when I say dangerous, it's not moving towards 80. We're not getting to that all-out momentum. It's kind of stuck in no man's land. So this is in terms of sort of macroeconomics, the fact that wheat is rolling over. That's a good thing. Now we just want to see. I just want to measure something here. Now we just want to see if it can sort of normalize. Let's just do a trend analysis here. Okay, so let's take a look at these peaks and troughs. I'm going to just take this out. I want to take, let's change this to a P. Let's take this out. Okay, and let's change this just to a P. Let's use these as our references. So take this H out. All right, so you've got this peak and trough. Here's your let's call them the anchors, your references. Here's the higher trough. Okay, here's the higher peak. So this is an uncomfortable higher trough, higher peak is uncomfortable in terms of stagflation. And then we had, are we going to see a higher trough come after this one? And we've got our answer now. We've actually got our answer now, and we've got a lower trough. Let's just add that in. Okay, so we've got LT here. Let's put that in. Now, how do I get that? Well, it's very easy. What you want to do is you want to go to your higher trough, which is here. What's the low? Your low is 1033. Okay, 0.82. You go to the low here. Well, it's 1026. It's lower than here. So we've got this lower trough in. So what does that mean? Well, it means that the uptrend's effectively been broken. Okay, because there's a definition for an uptrend. The definition is higher trough followed by higher peak, followed by higher trough followed by higher peak. We don't have that. We've got a lower trough now. Does that mean we've got a downtrend? No, it doesn't mean that. All it means is that we've broken the uptrend. Just like an uptrend's got a definition, downtrend's got a definition. What's that? Lower peak followed by lower trough. Lower peak followed by lower trough. So we don't have the lower peak here. So what we want to effectively get is something like this. Sorry, I beg your pardon. Something like that. Low peak, low trough. Then wheat prices are coming down. Okay. So what's the big deal? So we've looked at wheat, we've looked at natural gas, we've looked at oil. So this is something we've mentioned before, but I think again it's worth just taking a look at just basic economics 101, right? Every economy has got what we call potential. Okay. So potential is where is the maximum that you can really produce. It's the maximum place you can get. Now it's not fixed. It's not fixed in time. As technology improves, as your labor force gets more skilled, as more skilled laborers immigrate and get absorbed and start contributing, more efficient use of natural resources, you can shift your potential out. So where potential was at the turn of, say, the 20th century, at the turn of the turn of the 20th, is very different to the turn of the 21st. Is very different to where we are now, and that's because obviously it's called your total factors of production. You become more efficient with it. Okay, so you've got potential, and if you operating at your potential, well, that's kind of Goldilocks. That's where you want to be. Okay. So let's just use a hypothetical. Let's just use a hypothetical aggregate demand, aggregate supply. Now, I'm not going to use GDP here on our x-axis. I'm going to use the variable employment, just because I think it's more sort of more impactful. So instead of saying potential, what we're going to call potential, we're going to call it full employment. Okay, so here's your sort of full employment level. Full employment doesn't mean everyone's got a job. Every economy has got a natural rate of unemployment. That's inside full employment. It's called NARU, natural rate of unemployment, NARU. All right. On the y-axis is your price axis on any sort of demand supply. We're going to call it inflation, just because it's more impactful. Right? It's more impactful. Okay. Now, if you go past your full employment with demand, if you go past it, that's a problem, because you are running an economy, you're overheating your economy, which has ramifications. The most obvious ramification is inflation. Okay, that's but at the same time, okay, if you are running below full employment, then you have something called an output gap. Okay. All right, Howard. I'll see you later. Anything to the left of full employment, you have what's called an output gap. So the central banks are always kind of trying to solve the issue: are we at an output gap or an inflationary gap? Output gap, inflationary gap, and they can manipulate this curve. This is called aggregate demand. This is where interest rates influence. Okay, so that's what the central banks do. What we've seen with higher natural gas, what we've seen with higher oil, and what we've seen with higher wheat, which seems to be moderating, is a shift not in demand. We've seen the shift in supply. Okay, that's what's called that's a supply shock. There's less supply. There's less supply. So we've got an excess demand of oil. That means there's not enough supply. Okay, we've got an excess demand for natural gas, not enough supply. There's a shock. It's pushing it to the supply curve. So it's affecting employment. Okay, and incidentally, we'll see what happens in the NFP today. it's forecast at 320 to 325,000. I think it's going to come in lower, but we'll see. You know? But so now you're getting a drop in employment, but at the same time you're getting your inflation. See, getting your drop in employment, and you're getting your inflation. Now contrast that. Okay, contrast that with demand side problems. Let's take a look at demand side problems. Remember now, the supplier is giving us inflationary pressures. So how do you get inflation on the demand side? Okay, it pushes outwards, but that's a different type of inflation because it's not hurting your employment. If anything, employees are now being forced to work overtime. They're getting paid more, right? And that's why there's at least if there's a demand side shock, okay, we've got a problem with inflation, but like our employment, it's not. The employment's not getting affected. Okay, look at supply side. Look at supply side. Okay, let's go back to supply side. What's happening here? Supply side, you're getting a double whammy. Okay, that's the problem with stagflation. This is stagflation. Supply side shocks or stagflationary. Okay, there's your increase in inflation. There's your drop in employment. Okay, so that's the problem with the charts that we've been looking at this morning, is that I'm not sure that we felt the full ramifications that it takes time to transfer these type of shocks through the economy, right? So that's what we're dealing with. All right, let's take a look at non-farm payrolls this afternoon. Let's see if the x-axis is going to get let's see if the x-axis is going to get hurt. Now we'll just take a look at one. Let me take a look. I want to bring up Forex Factory as well. I'm sorry, it wasn't on our sources, but let's just take a look at this and then we'll conclude. Let's just bring up Forex Factory. All right. Okay. All right, let's just let's go back to yesterday. So this is just open up unemployment claims here. This is a good number. This was better than I expected. Okay, just open this up. Okay, hang on a second. There we go. Now watch. Why do I want to watch this? Can you see this going back to April? You see April here. So April we had really good numbers. Now look what's happening. It looks like it's slowly starting to tick up. See that? Slowly starting. That's not a good sign. So there's 200,000, which came in better than forecast. That's good. Remember, we looked at hourly. We looked at hours worked last week. It's coming. Those are coming down. So I'm worried about this the supply shock. So I'm of the opinion that until we can get natural gas under control, we mustn't be sort of lackadaisical about it. It can turn into a serious issue here. If we can get it under control, that's first prize. So let's take a look and see what happens. Non-farm payroll, very, in my opinion, today's non-farm payroll is a very important number. We want to see a beat. Okay, we want to see a number come in higher than 320, 325. I'm expecting, and I hope I'm wrong, a lower number. But let's see how it materializes. Okay, we'll stop over there. We've got the non-farm payroll later today. Again, the link is in the chat. If there's any issues, just email me, rshore@fxcm.com. Yeah, okay. Just another comment coming from Anna. She's really posting some good stuff today. There's a huge number of developing economies on the brink of default. How does this tie into your way of thinking? Yeah, so what she's effectively saying is developing countries hold debt. Okay, they hold debt, and that debt is denominated in US dollars. It's denominated in US dollars. Okay, so you've got to pay back US dollars, right? It doesn't take much to see that the US dollar appreciation is killing them. Okay, killing them. Yeah, so that is a serious problem, and I don't have an answer for that. And what you're saying is 100% correct. This is hurting a lot of countries. I would suspect any country that's holding debt, plus the interest payments. The interest rates are moving up now. It's not so bad to hold debt when interest rates are at 0, right? As soon as they start moving, well, it's a different story. That's going to be an interesting dynamic come ECB increases, because out of the 27, some of the 27 hold more debt than others. Okay, so when the ECB starts raising rates, they need to raise rates. Inflation is over 8% in the Eurozone, but is there going to be some sort of political sort of resistance inside of the ECB? That's a huge factor that we need to follow as well. All right, guys, let's conclude here. Thank you very much for joining this morning. As always, it's very much appreciated. See you guys 10 minutes before non-farm payroll. Yes.